Hi. Last time I spoke about investors' temptation to find the formula, the key factors that tell where stocks are going. 25 years ago, in the 1990s, I too was infected by this search for investing holy grail. This was before I understood that only exclusive physical facts that I sleuthed myself can help me find individual multi-baggers, not forecasting the entire market. Well, at that time, neural networks began to be the thing. 2 decades before then, an MIT professor by the name of Marvin Minsky proved that neural nets cannot do much because their simplest form, also known as a perceptron, has limited ability. I still have his book. It's big and weighs at least 2 pounds, with color diagrams too. Minsky's proof against neural nets was impeccable, so scientists like me stopped trying to use them. Until 1986, when a paper was published by Rumelhart, Hinton, and Williams suggesting to simply add middle layers to the perceptron, and voila! The nets began to forecast like a charm via something called backpropagation. And so, soon neural networks began to be used on production lines to identify broken parts, or on sorting lines to identify rotten tomatoes, or yes, on Wall Street to weed out rotten stocks. Now, Jeff Hinton was teaching at the time in the University of Toronto, so I sneaked into some of his lectures, then read his papers, and finally got myself a simple neural net called BrainMaker that plugged right into Microsoft Excel. All one had to do was decide which factors one thought would influence the market, train the net on a period of market history, then see if the net could forecast the market during an unrelated future period. Simple, right? Wrong. Because doing this assumes at least 3 things. First, that the same factors that influenced the market in the past will influence it in the future. Well, says who? Second, that the factors that do influence the market can be put into numbers. Again, says who? At the time, I had not yet boned up on quantum physics, where some factors are not measurable, or once you do measure them, they change on you. But third, the process of fine-tuning the net again and again until you find the factors that fit is really a method of curve fitting. That is, forecasting the past, not the future. However, at the time, I didn't do any of those things, so I went merrily away collecting data that I could use to forecast the market. All in all, I narrowed it down to about a dozen variables, and one weekend I plugged them into the net and let it learn. This was 1994, and I well remember my excitement when I got the results. It works, said the net. The market's rise, it said, was just beginning. Yes, we were about to embark on a strong bull market that can last a few years. So, with the zeal of a prophet who wants to share his wisdom with the world, I wrote an article about it, sent it to Barron's editors, and it was published. The time, remember, was 1994. And as luck would have it, the market kept going up, and my inbox was soon filled with emails of excited strangers who complimented me and demanded my market opinion for free, since, after all, they had paid $1 for an issue of Barron's. Then, a good friend of mine, a Stanford PhD in math, asked me gently which of the dozen variables I used were, in my opinion, the most meaningful to the forecast. This stopped my self-congratulation because, as my Stanford friend gently made clear, I broke one of the first rule of forecasting. Use as few factors as possible. Freeman Dyson, the physics genius who explained both Einstein's and Feynman's work, tells how he went to Enrico Fermi, one of the fathers of the atomic bomb, with a model forecasting some particles' behavior. Before even looking at the model, Fermi asked Dyson how many variables the formula had. 4, said Dyson. No good, said Fermi. For a good model, you need only 2 factors. If you let me have 3, he said, I can model an elephant. And if you let me have 4, I can model its trunk too. All of which goes to say that if you use too many factors in a model to forecast future behavior of the market or a stock or anything, and you do it again and again until you find just the right factors, then all you've done is fit the factors to the past, not the future. So, my Stanford friend said, instead of running a neural network, why don't you just run a simple regression on your dozen factors and find via the t-statistics which variables matters most? Shamefaced, I did just that, and what do you know? I found that 3 of the dozen variables were enough to forecast most major long-term moves in the market via a simple regression. So which were they? The first was the money supply. The second was the market valuation. The third was real interest rates, in that descending order. But once you got those 3, you got 70% of future market behavior. The other variables were almost immaterial. Why these 3 variables and not others? This, of course, the net didn't tell me. But over time, as I showed the result to more friends smarter than me, the following emerged. Number 1, the money supply is the rocket fuel of the market, produced by the Fed, which can make limitless amount of it. Once it does so, and the new money gets into the hands of investors, these will buy stocks, because once stocks start going up, big investors cannot sit by with cash because they will then lose their jobs, since their job is to outdo the market. So, Fed printing is good for stocks. Fed sucking money out of the market, bad for stocks. And that's about 40% of the market behavior. 40%. Or as they say on Wall Street, don't fight the Fed. Factor number 2, market valuation matters a lot. If the market is cheap, on whatever criterion you care to choose, you are likely to make money with stocks over the next 5 to 10 years. Which criterion is best? Warren Buffett uses total market cap of all stocks divided by GDP, or you can use price to sales of all stocks, or average PE of all stocks, or anything similar. Now, this won't tell you if stock will go up tomorrow or next month, but it will tell you if they are likely to be up or down in 10 years. And that's about 20% of the weight. The third and last factor is real rates, or AAA bonds, less yearly rise in the PPI, Producer Price Index. This is the real cost of money. When it's high, the economy is strong, and stocks are likely to do better. If it's low, the economy is weak, and they won't. This factor is about 10% of the weight in the forecast. All in all, about 70% of the market outlook is determined by these 3 factors. And this outlook, remember, is for 5 to 10 years, not next year, certainly not next month. After I did the regression, I saw my friend was right. The neural net was unnecessary. A simple regression will do. And before you ask, what does this neural net turned into regression say about today's market? It says exactly what you could say yourself with some decades of market experience and a head full of gray hair. Today's market is more overvalued than in 1929, more than 2000, more than 2008, on any criteria you choose. And that's very bad for the market outlook mid and long term. On the other hand, the Fed is insanely accommodating and is money printing as widely as in Weimar Germany, France during the 1789 revolution, or Venezuela of the last decade. That's good for the market, but only short term. But as for corporate rates, they're negative, the real ones I mean, since the annual rise in producer prices is much higher than interest rates. So what's the bottom line? It is this. The economy is very sick and the market is crazily expensive, but the Fed insane money printing is likely to keep the market dancing just a little bit longer. But then the dance will probably stop all at once. Where will that be? This, the net, cannot tell you, nor I. But the net can give you a hint via the connection of real rates to inflation. That is, when higher producer prices seep into consumer prices and inflation ticks up, the Fed will be forced to withdraw money from the system. It most likely won't do this via higher rates, but by reducing the purchase of T-bonds, which the sick market, like an addict whose heroin IV is yanked out, will feel immediately and likely crumple. Which is why I keep selling stocks into the rise, keeping a wary eye on these 3 key factors, ready to accelerate my sales if and when the Fed's crazy monetary heroin suddenly stops. That's all for today. Please tell me below what you think of the above. Give it a like, subscribe to the channel, then tell your friends about it so they subscribe too. I'll see you next time. And meantime, thank you very much for watching.